The average true range is good too when it comes to adapting to the ever-changing market environment, being useful indicator in measuring volatility. The advanced average true range measures the price range of the asset. The higher the volatility, the higher the ATR. The average return range is one of the most useful indicators because it helps the trader deciding on where will set a stop loss or profit target, or if he even should open a trade in the first place. The ATR is measured as the greatest if any of the following three metric: the value of the current high minus the low. The distance is current high minus the previous close. The distance is of the current low minus the previous close. Despite the fact the average true range is not so common among traders, this indicator can aside them in entries and exit traders. The ATR indicators move up and down as the price movement become larger or smaller. And your ATR reading is calculated as each time period based on the 1 minute chart, and your ATR reading calculated every minute. On a daily chart, and your ATR is calculated every day. All these readings are plotted to form a continuous line, so traders can use how volatility has changed over time. An asset range is difference between the highest price and the lowest price on the given day. The average true range covers information about how volatile the asset actually is. High range variable high volatility, while small range suggests low volatility. The average true range ATR is basically the exponential moving average of the true range. Most common settings of this indicator are the 14-day ATR depending on their trading objective or the time frames. Traders can use shorter or longer inputs of the ATR. Longer ATR will be slower and will generate fewer trading signals. Shorter ATR will generate a higher numbers of the trading signals and will increase trading activity. For example, an average true range of only 5 periods would not offer a large enough sample to generate an accurate indications of the true range of the security, and average true range of the 50 periods would generate more smooth average true range on one chart with fewer and possibly high quality signals. Let's assume that you are using a slight trading strategy and you are using the ATR with the 50 periods input. You should keep in mind that if you are trading the daily chart, the ATR indicator will indicate the average volatility over the past 50 days. However, if you are trading the 4-hour chart, the ATR indicators will display the average volatility of the past 50 H4 candles. So ATR's value differ from time frames to time frames. It's not a unique value. How to read average true range indicator? First, ATR represents a range indicator for filters out trades. If you prefer volatile markets or if your trading strategy is based on the huge market moves, the ATR can filter out markets that are low in volatility. Even if you prefer calm, quiet markets, the average true range indicator will help you to filter out those periods of times that you would prefer to avoid. It is important to remember that the ATR does not measure the market directions. By tracking the average true range, a trader cannot identify the prevailing trend on the market. The ATR only tracks the magnitude of the range, so it has limited use for generating accurate trading signals. It's a useful indicator only for giving an idea about how much price may move in the different time frames. Assume a stock moves $1 a day on the average. There is no significant news out but price has already moved, let's say 50% more than the average, and now you're getting in the buy signals from the strategy. The buy signals may be valid, but since the price has already moved significantly more than average, and betting that the price will continue to go up and expand to the range even future may not be prudent decisions. The trade goes against the odds, since the price is already up sustainably and has moved more than the average. The price is more likely to fall and stay within the price range already established, while buying once the price is near the top of the daily range isn't prudent. Shorting is probably good options, assuming that the valid sales signals occurs now. Very important entries and exits should not be based on the ATR alone. ATR is a tool that should be used to conjunction with the strategy to help filter traders. For example, in the previous situations, you shouldn't sell simply because the price has moved and the daily range is larger than usual. You short only of if a valid sell signal occurs based on your particular strategy. Second, the ATR formula will assign you in the settings profit target. Knowing the average range is extremely useful, since it allows the trader to estimate how much profit potential there is in the market. For example, there is no point looking for 200 pips of profits from the target in the current pair, or if the average turn range for the market over last 14 days is only 60 points. Similar solutions to have the 40 days ATR instrument and use this figure as your profit target. Those after entries trade in your could set yourself the profit targets of around 30 points. How to trade with the average turn range. ATR indicator is useful to identify low levels of volatility. Average turn range doesn't tell traders anything about the market directions. Don't get confused about these directions. If average turn range is going to the chart, that doesn't mean that the trend is up. A visible strategy would be to search for the low volatility levels in order to find a target in the directions of the main trend. The first things we need to do is to identify where the low volatility actually is. Keep in mind that the low volatility itself is not enough for the new trend. This translates into the fact that the current trend has run out of steam. Doesn't tell us that the new trend has begun, so we must use average turn range to conjunctions with other oscillators or price actions. For example, in this example, we identify low levels of volatility, but we cannot enter the market blindly. A smarter approach would be to wait for the average turn range to exit from the level and confirm the volatility increase. With the trend line breakout on the chart, or a rising stochastics, for example, or a divergence on the RSI or CCI, depending on your strategy. Second strategy involving using ATR as the trading stop loss. A trading stop loss is a way to exit the trade if the asset price moves against you, but also enables you to move the exit point if the price is moving in your favor. Many days traders use the ATR to figure out where to put their trading stop loss. Here's how it works. At the time of the trade, you look the current ATR reading. Our rule of thumb is to multiply the ATR by 2 to determine the reliable stop loss point. So if you are buying stocks, you might place a stop loss at the level twice ATR below the entry price. If you are shorting stocks, you would place the stop loss at the level twice the ATR above the entry price. If you are long and the price moves favorably, continue to move the stop loss to twice the ATR below the price. In this scenario, the stop loss only moved up, not down. Once it moved up, it stays there until it can be moved up again or the trade is closed. As a result, one of the price dropping to hit the trailing stop loss levels. The same process works for the short traders, only in the case the stop loss only moves down. For example, you say you take the long trades at $10 and the ATR is 10 cents. You would place the stop loss and $9.80, the 10 cents ATR multiplied by 2, the price rises to $10.20 and the ATR remains at 10 cents. The trading stop loss is now moved up to $10. When the price moves to $10.50, the stop loss moves up to $10.30, locking at least a 30 cents profit to a trade. This would continue until the price falls and to hit the stop loss point. Now here's interesting indicators. In order to make it easier to visually see where those stops would be, you could use the ATR bands. This indicator will show an upper and a lower band around the price, showing where you can put your stops or trio them in open positions. You can use ATR bands in a number of the ways. It's an easy visual way to see where you can place your stop loss. You can use a multiple of the ATR as your target. You can trail your stop alongside the ATR bands. ATR bands indicators has only two variables, the period and the multiplier. By default, ATR period is 724 with the variation about the 1 day has 24 hours, so that way we are getting the average price movements for the past days. However, if you are day trading, it could be useful to trade to have a shorter ATR period. For example, if you want to market recent price volatility more relevant. ATR multiple also depends on your trading styles. Let's say your current ATR value is 20 pips and you use multiplier on the 2, then the bands will be at 40 pips on each side. If you use the multiple of 3, the bands will be at 60 pips on each side. There is no universal rule for setting stop according to the ATR. It depends on each trader individual risk reward risk tolerance, while also allowing to the trade bit height room to develop. So backtest and close the settings that are in the line with the strategy. As you probably know, one of the most important aspects of trading and investing is having the disciplined risk management process, because the ATR does not measure directions and simply considers the magnitude of the range. It has limited utility as the means of the generation trader signals, but is useful tool for providing an idea about how much the market may move and will help you to apply the proper position size and the proper stop placements. If you learned something new and found value, let's like to share your support, subscribe to our channel and click the bell icon to stay notified when we release new video. Until next time.